What is profit-loss sharing, PLS, in Islamic banking? Imagine a system where your savings are not just sitting in an account earning a fixed interest, but instead are part of a real business venture. That's what profit-loss sharing is all about. It is a key principle in Islamic banking that replaces the traditional interest-based system. Instead of earning interest on deposits or paying interest on loans, both the bank and the customer work together to share the profits and losses of a business or investment. This approach is based on fairness, transparency, and actual economic activity, aligning with Islamic finance rules. At its core, profit-loss sharing means money should not generate profit just by itself. Instead, profits come from real business activities involving tangible assets or services. Islamic banks do not simply lend money for a fixed return. They form partnerships or joint ventures with customers where both contribute capital, skills, or effort. Both share in the outcome, whether it is profit or loss. There are two main types of profit-loss sharing contracts used in Islamic banking. The first is called Mudarabah. In this partnership, one party provides the capital, which is usually the bank or investor, and the other provides management or labor, like the customer or entrepreneur. If the business makes a profit, it is shared based on a pre-agreed ratio. But if there is a loss, the provider of the capital bears it, unless the loss is due to negligence or misconduct by the manager. Mudarabah is often used for investment accounts or financing projects. The second type is Musharakah. This is a joint venture where all partners contribute capital and may also participate in managing the business. Profits are shared according to an agreed ratio, which might be different from their capital contributions. However, losses are always shared in proportion to each partner's investment. Musharakah is common for business financing, project funding, and sometimes for home financing. In both models, risk is shared between the bank and the customer. Unlike conventional loans where the borrower bears all the risk, Islamic profit-loss sharing ensures both parties are responsible for the outcome. This encourages responsible decision-making and fairness. Profit-loss sharing is closely linked to real economic activities. The bank's profit comes from actual business profits, not from interest or speculative transactions. Investments must be in halal or permissible sectors, avoiding industries like alcohol, gambling, or anything harmful. In practice, Islamic savings accounts often operate on a Mudarabah basis. Customers deposit money, and the bank invests it in Shariah-compliant ventures. The customer then shares in the profits or losses, not a fixed interest rate. For home or business financing, Musharakah is often used, where both the bank and customer own the asset and share in its benefits and risks. It is worth noting that while profit-loss sharing is a core feature of Islamic finance, many banks also use other contracts like Murabaha or Ijara for specific transactions. These are used when PLS might be less practical or riskier. Still, PLS remains the ideal model for promoting ethical and economic goals in Islamic banking. To sum up, profit-loss sharing in Islamic banking means banks and customers partner in financial activities, sharing both profits and losses based on their agreement. This system avoids interest, promotes fairness, and connects banking to real economic growth. For customers, their savings or financing become part of a genuine business venture, with returns reflecting actual performance rather than a fixed rate.